All right. My name is Alexander Bigby. I'm one of the consultants with Fund17 on their Capital Ready program. I also run a nonprofit called Flight, which is a New Orleans-based nonprofit that helps create free financial education resources and deliver them to communities and individuals across the city. So as part of that, Fund17 asked us to host a webinar on credit scores and credit management. So we have the wonderful Phoebe Brown from Hope Credit Union, who works very closely with us on a lot of our programs. And she will be giving a presentation today on credit scores and credit management. Phoebe, how are you doing today?
I'm doing wonderful, Alex. I'm doing wonderful.
Very, very glad to hear it. So I will be sharing my screen during this presentation, and Phoebe, you just tell me when you want to move to the next slide, and I will let you take it from here.
Okay, thank you so much. Well, first of all, I count it a pleasure to be here with you on this morning approaching noon hour to talk to you a little bit about credit. So on today, we're going to kind of look at credit management and credit scores. So I hope that this information will be useful to you in your planning and anything that you're trying to accomplish. To tell you a little bit about myself, my name is Phoebe Brown, and I'm the Financial Inclusion Officer with Hope Credit Union. Now, that just simply means that I actually teach financial education and I market the services for Hope Credit Union. And Hope Credit Union has just recently celebrated 26 years in existence. We're actually in 5 states. We were formulated in Mississippi, and we are also located in Arkansas, Alabama, Tennessee, and Louisiana. So there's a whole lot about Hope out there. If you visit our website at hopecreditunion.org, you can actually learn more about our services, and we would love to invite you to become a member of our wonderful credit union, for we are a community credit union, so you don't have to belong to any workforce or have a relationship with anyone to become a member. So let's get started about credit management, how to get on the right track. Next slide. So here we talk about defining credit. Now, most of us learned about credit the hard way. We made some mistakes. But what is credit? What is it actually? Well, just understand, I give you a definition here, but credit is actually the ability to obtain a service, and you're going to pay for it later. You're not going to pay for it now. So you actually pay for what you're using in the future. So it's using your promise that you will be able to pay later. So that's pretty much what credit is. It's trusting you to take care of your obligation in the future. Next. So here I present to you a question. Why do credit reports and credit scores matter? We hear a lot out there on the radios, and we hear financial presenters always talking about get your credit report, know your credit scores. But why does it matter? Why is this important? Next slide. Here you would see that we defined what a credit report is, because in order for you to know why the report matters and why the score matters, you got to understand some definitions. So just simply tell you here that a credit report is a consumer report, and it's the written history of some of your bills on how you paid your bills. Did you pay it on time? Were you late? Were you considered a slow payer? So this is your history, and it is public record for those of you that are trying to make credit decisions as to whether we want to grant you credit or deny you credit, or that we would want more information from you. So credit reports, it contains information about how you used your credit in the past. Do you even have any open credit? Because like we said, credit is a promise to pay in the future. So the credit report holds those promises in a file to show whether you took care of your obligations on time or were you a little behind. Next slide. So why do credit reports and credit scores matter? Well, the first reason is, especially in this time, it's important for you to understand that credit reports and credit scores matter in order to get and keep a job. That's right. A lot of jobs will pull credit reports to determine your credibility. Were you able to handle your financial obligations? Now, for me, example, I told you, I work for a credit union. Now, I'm not a teller, which credit unions call them merchant service reps. I'm not one that handles money, but I do have a certain time where I may have to. So in order to work in these financial industries, such as a credit union or a bank, they may pull your credit report. Now, why? Because when you're under stress or you're going through something, you have no idea what you might do. You may say, I would never steal. I would never borrow anything without asking. Well, sometimes when you fall into difficult times, you may dip your hand into the till and say, well, I'm going to put it back before the end of the day, but you end up not. So it poses a risk for the establishment, but it also says whether you can take care of your responsibility and have you taken care of your past financial obligations. Also, credit reports and credit scores matter in order for you to get and keep a security. Now, people don't really know this, but I had to work with a lot of military in the past. In order to get clearance to travel overseas or to do business with out of the country entities, you need a security clearance. But if your credit is not really good, it could prevent you from being cleared. So a lot of military positions, pretty much soldiers have to have pretty good credit because it can revoke their security clearance. We've heard of individuals actually losing their ability to travel, or you've heard of individuals being investigated for selling United States trade secrets. So that does affect your clearance. Also, you will see to get an apartment, credit reports and credit scores play a function in that. If you lived at Oak Tree Apartments and now you're moving to Green Tree Apartments, well, you left a balance at Oak Tree, do you really think Green Tree will want you to be there when you are still outstanding at the last apartment that you rented? I doubt that they would, because that means that, hey, you may up and leave them with a balance and they would have to run behind you for their money. Also, credit reports and credit scores matter to get insurance coverage. Now, many people are not aware of that, but it does. Why? Because you've heard of insurance fraud. So let's say you have a vehicle, it has some value to it, but you're about to lose it because you haven't been able to make payments. And so you in turn then hire someone to steal your car so you can file an insurance claim. Well, that's a risk and it's actually fraud. So it's called insurance fraud. So insurance companies will pull your credit report to see if there are any things or any red flags out there to prevent you from paying your insurance claim and possibly not doing a fraudulent claim against that claim. So get lower deposits on utilities and better terms on cell phones. Yes, utility companies and cell phone companies can pull your credit report as well. But it also helps you not to have to come up with large deposits and possibly to have a service turned on immediately. Because if you still owe past utilities, utility companies can decide not to grant you service until those utilities are paid. Also, credit cards and loan terms. Credit reports and credit scores matter in those areas because, once again, the reports are telling us your ability and your habits of how you paid your debts in the past. So you can be declined or approved for the credit cards as well. Next slide. So the impact of credit, as we stated, it covers a wide range of things. You see it covers insurance, employment, it covers military, professional credentials is another one. That if you are actually going to school to get a professional license and your credit is shot, but you finish your program and you've graduated, like for example, being a lawyer or being an accountant or anything like that, yes, in order to get your license, your credit pretty much has to be on the good side of the spectrum. Why? Because just think about it. If you're scheduled to have heart surgery and you have a doctor that's coming in to do heart surgery and he's about to lose his home, his car, his whole practice, do you really think he's concentrating on your surgery? I doubt it. So yes, getting professional licenses is key. When you finish law school and all of those different things, it can lead you to do practices that are not favorable to the law. So credit can impact you in being able to receive those licenses if the credit is not resolved. Also, you will see that it impacts your ability to buy housing and your interest rates. Your interest rates can tend to be higher if your credit does not reflect a good repayment history. But your key is you want it to reflect a good payment history so you can get lower interest rates and be favorable to be able to take care of all of these things. Next slide. So there are wise uses to credit as well as unwise uses. So wise use to credit, of course, is assets. And we know assets can come in the form of a house or a vehicle. Large payments such as, or large financing, I should say, is not always readily available to us in cash. So we need credit, meaning that we must finance what it is that we want. So in order to buy a house, not many of us can actually walk in and pay $150,000 in cash. So we have to get a loan. And getting a loan, you will need credit in order to do that. So if your past experience with credit hasn't been good, it is a chance that you will not be able to buy that house, or you're going to pay a higher interest rate in vehicles. Also, credit is wise for convenience. A lot of individuals don't like to carry cash. So if you don't like to carry cash, that's fine in order to use a credit card. But you have to remember, don't charge what you really can't pay back. So if you're using it not to carry cash, but when the bill comes, you can pay out what you've spent, then it is for convenience because you have it, you can use it, and get the items that you need. Also for emergencies. We know from the picture here that if the car breaks down and it's a major repair, most of us don't have the cash just to walk in and get a whole engine repaired or a whole transmission replaced. You may have to use credit to do that. So credit does buy you time in order to be able to get what is broken fixed and move on and then pay the bill when it comes, even if it's in increments. But it does get you over the hump of that emergency. Next slide. Also wise uses of credit you will see is for higher education. Now I know we all complain about student loans, but can we really walk in and pay $30,000 to a financial to a college? No, we have to get something either from a financial institution or from the government, which is in the form of student loans. So student loans does help you to be able to get that higher education and to be able to graduate in a field of study where you can come out and work a job making a higher means of wages. where you can then pay back the student loan. So it is a wise use, but I have to advocate that if you're getting student loans, only get what you need for school. Don't over borrow, meaning that you're borrowing more than what you need for school because you want to live off a portion of it. Remember, the loans have to be paid back, and you also need to know the terms of the loans. Credit is also good for vacations. Now, we know that a lot of us, we like to travel or we want to get away from the hustle and bustle of everyday life. That's fine. You can use credit for vacations. However, make sure that you're doing this wisely as well. Don't go out and just finance a trip because you want to go to Europe. Do you have a means of paying it back? Or are you going to carry this trip to Europe, that expense, for years and years to come? So we're not saying just use credit so you can enjoy the fruits of your labor and travel, travel, travel. We are saying that if you use credit, do it wisely, because a lot of credit unions and banks have what they call vacation clubs, to where you can actually start saving for your vacations. Next slide. Now, just like there are wise uses, there are also unwise uses of credit. So some unwise uses is impulsive buying. We're at home right now, a lot of us, and you're on the computer a lot, and you see all the great sales. Now, I'm saying, yes, support your small businesses and support businesses anyway, but don't overdo it. Don't just impulsively buy a flat screen television because it's a great price. Do you have a plan to pay it? Don't just spend because it's a great sale. You think through what you're purchasing. And I always like to call this the exhaling moment. Think about what you're actually trying to purchase. Think about the cost of what it's going to run you later. And then take a day before you do it. Because if you feel that you really can't live without it, a lot of times you can talk yourself out of that purchase and avoid the impulse buying. Also, spending to feel good. Right now, individuals are going through some depressions because maybe of job loss or maybe for just being at home alone. Whatever it may be, don't just spend money to feel good, because in the long run, you will have spent too much, and then you will have the buyer's remorse, which will lead to more depression, and you will then just have that continual cycle where you're spending to feel good, but then you go into this downward spiral because you spent too much. So be mindful of that. Really take that moment, take a breath, and ask yourself, why are you making this purchase? How much is it going to cost you in the future? And can I really afford this? Or can I really just live without it for now? Spending for status is something that some people don't think about, but we've all heard the term living like the Joneses. So let's say you get that great job, but you notice everybody in this job, they're actually dressing a certain way, they're driving a certain vehicle, and you want to fit in. Be yourself, because if you're spending for status, like that saying about the Joneses, Joneses might have one foot on a banana peel into bankruptcy, and you don't know that. So don't go down that road. Spend what you can only when you need to. Now, everyday living expense can be it is an unwise use, but it can have a wise use attached to it. I told you in the other slide that sometimes people don't carry cash, so they use credit for convenience in order to buy the things that they're purchasing. So it's okay to do that, but when the bill comes, pay it out. So if you were going to pay cash for it anyway, hold the cash in your bank account, use the credit for your living expense, but then when the bill comes, remember the cash is already there, so you can then pay out the debt. Next slide. So what is a credit score? Now, this is something that we hear a lot about. Get your credit score, get your credit score. but we don't know what it is. A lot of individuals don't know what it is, but some do, and some have myths about a score. So let's look at what a score truly is and what it means and why it matters. Next slide. A credit score is a number that helps a lender predict how likely an individual is to repay a loan or make credit card payments on time. So simply put, a credit score is a statistical number to say what is the likelihood you're going to repay. So if the credit report doesn't reflect a good payment history, the likelihood of you repaying me is probably not going to be very strong. So lenders or creditors, they decline you for that reason, or they attach higher deposits in order to have what they call a cushion or a penalty base in case you don't repay. A credit score is also a number that changes as the elements in your credit report change. So when you pull your credit report today, that credit report history is the past, but the credit score is per the day you pull it, so it is the present. So if things change in the credit report, like you open a new piece of credit or you pay off credit, that will impact your score. Whether it's good or bad, the score will change. So there are algorithms that causes the score to fluctuate. A credit score has a broad use and impact. Your credit past is your credit future. So what we mean here is that the credit score is, once again, per the day, but it can impact your present because of what your past actually shows. So remember, there are a bunch of credit scores out there. There's over 60 different scoring systems, but the FICO, F-I-C-O, which stands for Fair Isaac and Company or Fair Isaac Corporation, those scores are the most common credit scores that the lenders and creditors use because it's been around since the 1960s. Now, there are new scoring systems out there, but the FICO score is proven. So the scoring system will vary with all the different scoring algorithms out there, but FICO, it normally ranges between 350 to 850. The newest score that most of you've heard of or maybe haven't, but you may have seen, is the Vantage score. The Vantage score is a new scoring system that was created and developed by the 3 credit bureaus. And those credit bureaus came together and put together a scoring system that they felt would kind of put the scores in the same range. However, the scores will always look different because there are 3 different credit reporting agencies and they score differently per each type of trade line. So remember, they'll be close on the Vantage score, but not necessarily the same. The Vantage score is what you see on Credit Karma. That is why I say you may have heard of it or you may have not heard of it. But most creditors and lenders, we stick with the FICO score. Next slide. Here you will see what makes up a typical credit score. But first, I give you an example of the credit score model. Now, this model really is based from housing, the home ownership spectrum. But this is how a FICO score will look and how it's rated. So if you have the maximum score of 850 to 720, you're considered in an excellent status. 719 to 680 is very good. Those 2 areas, you have the power to borrow. That means you have very little, if any, flaws, and you're pretty balanced with your credit. Also good is a great area to be in as well. 679 to 640 is the score range. So here you have borrowing power also. 640 is the lowest cap that FHA in the housing arena grants loans. Anything under that has to be a program that either lenders or creditors have put together in order for you to be able to borrow. So below average would be anywhere from 639 to 600. Anything below 600, it's not good. You're gonna need to work on some things. So keep that in mind, that these are the things that make up your scoring system when you look at those different scores. It gives you the range of where you would actually fall. Then you have the pie chart that's over to the right. This pie chart gives you the 100% piece of what portions are included in your score. How does it actually pan out? So 100% of your score isn't in just one area. It breaks into these particular slices of the pie. So let's look at these slices. Next slide. You will see that the most percentage is your payment history. Your payment history is showing your ability to pay. So late payments will impact your score tremendously. Hear me carefully. One 30-day late payment, it can drop your score by 100 points. One late payment, one 30-day late payment. So you never want to pay late. You always want to pay your creditors on time. Now, this is the area where some people struggle, because you might have one 30-day late, and then you want to know, okay, how long is it going to take my score to come up? Well, it's going to take anywhere from 6 months to a year to start pulling that bad hit up. Now, why? Because that big word that says history. You have to now create an on-time repayment history in order for the credit score to recover from that hit. Next slide. 30% of your score is outstanding balances. So that is the amount owed. So here's the area where you may have heard, or if you haven't, you will hear people say, never go over 30% of your credit limit. Meaning that if you have a credit card that's $1,000, don't run it up to $1,000, or don't run it up to $900. You want to be 30% or under of that limit. You want to look at floor to ceiling. Floor is your zero balance, ceiling is your limit. You want to be 30% or less away from that ceiling, because that allows you to have what we call utilization room. You can take on more credit because you're not maxed out. You're not used up, so to speak. So you want to use credit as wisely as possible, and you want to pay off credit, because the higher your balances are to that ceiling, the more you're paying out of pocket in order to pay down the debt. So that's why you will hear lenders say debt to income ratio. If your income can handle the debt comfortably, it puts you in a positive ratio. But if the income is riding hard against that debt, where you're paying a lot of money to keep that debt paid and keep it on time, that means you're in a negative ratio. So it means you have too much debt. You're overextended. So the key is not to be overextended, but to have utilization room where you have available credit to you. Next slide. %15 of your score is your credit history, the length of your credit history. Now here we're not talking about, oh, I have 20 creditors and I use them all and I pay them on time. That's not what we're talking about. What we're talking about when we say length of credit history is, how long have you had credit established? How long have you been using credit? Because a lengthy credit history actually builds up a positive score for you. Now, when you're young, it may be hard to get credit. So you want to be careful not to just go and apply for credit and constantly apply. You want to get maybe one or two things, have it there, pay it on time, and build up the number of years of your usage, because that does count in having longevity. This is the area a lot of first-time homebuyers mess up on, because they think, oh, I'm going to pay out all my creditors, which is good. but then they pay them all out and they close them. And so that actually freezes their credit to where there's no scoring on those past histories because everything is closed. And the score now takes a drop because your length of credit history has been closed. So you want to be very careful in that area because it can affect you in the long run. Next slide. 10% of credit is new credit. So if you open credit or you have applied for credit, you may have heard of inquiries. Here is where the inquiries actually appear. Inquiries stay on the credit report 2 years, but when you're searching for credit and you're searching too much, let's say you applied for 6 different creditors. Well, the inquiries show that you actually had them to pull your credit report, but we as lenders, we don't know if you've been approved for that until you use it. So that trade line can take a couple of months before it hits the report. So searching for credit can have a negative impact on your credit report if you're searching for too much at one time. So the number of accounts you apply for can impact you. When you open credit, that is only worth 10% of your score. So just be sure that you don't fall for the trick of if you go in and they say, hey, open this credit card and get 15% off today. That can affect you negatively if you applied for credit at 4 or 5 other different places. So be careful in this area, but it's only worth 10% of your score. Next slide. 10% types of credit. Now here is where you could use a service, like Credit Karma, and it might tell you, well, you need a mix of credit because all you have is credit cards or all you have is a car loan. So types of credit in use will give you a mixed bag of credit. So you may have loans, you may have credit cards, you might have a mortgage. That's what we mean in this area. The different trade lines of credit, what are they? Are they installment loans? Or are they revolving, which is credit? It's okay to have multiple lines, but once again, you have to take in consideration all the other slices of the pie because too much credit can impact you just as bad as bad credit. It has to be a balance. So you don't want to just open up a whole lot to say you have credit because it can be looked at negatively. But credit is not a bad thing. Unfortunately, it is the American way. So it is important to eventually establish credit if you have not. Next slide. These are the 3 national credit reporting agencies: Equifax, Experian, and TransUnion. They are 3 totally different agencies. Also understand that if you have credit, there are things that are called non-traditional credit and traditional credit. Non-traditional credit does not report on credit reporting agencies, but traditional credit could if the creditor decides that he wants to report it. Non-traditional credit would be things like your water bill, your light bill, even your cell phone bill. All those things are considered credit and can be used to help you to get a loan, even if they don't report on your credit reporting agency. You just need proof from the carrier as to whether you've paid your bills on time. So remember, these are the 3 reporting agencies and they report traditional credit, but you can use non-traditional in order to accomplish some of the things you want. Just be careful to always pay those things on time. Also with these credit reporting agencies, remember their scores will be different because what appears on one may not appear on the other 2. Next slide. So how can you get your credit report? You can get your credit report free from the Annual Credit Report Act, which is called the FACT Act. The FACT Act is the Fair, Accurate Credit Transaction Act that the government put in place. You can go to that website, annualcreditreport.com, to get your report. The only thing with this is to remember, you can only do this once a year. So if you did it today to pull your report, because we encourage you to look at your report, that's why the government put this in place. But you don't have to look at all three at one time. So if you wanted to do all three today, you could, but you won't be able to do this particular service again till June 24th next year, because it's annually. If you do one today, and let's say you wait 3, 4, 5 months later to do another one, 3, 4, 5 months later to do the next one, that's fine. It's just whatever date you did each one, you won't be able to do it until a year later. You can actually do this one of three ways. You can go on annualcreditreport.com, or you can call that 1-877 number and order the report, or you can download and complete the form requesting your credit report at the annual credit report request form and mail that into that address. And the address is on the form as well. Next slide. This is just a little snapshot of how the website looks. If you go to annualcreditreport.com, here I encourage you to actually be somewhere where you can print the report, because once you exit out of this system, if you didn't set up an account to store your information, then you won't have access to the report. The report only stays good for 30 days. So if you use this function, be sure you're somewhere where you can print the report to have it in your possession, because once you exit out, if you don't set up that account, then you will not be able to go back in within those 30 days to review the report. Next slide. So, tool 1, getting your credit reports and scores. We're giving you annual credit report. Understand that when you do this, if you do it online, you will not get your scores for free. However, you can purchase your score by using a credit card, or you can just get the body of the report, because that is what's really important in knowing what are the creditors saying about you. Remember this, it is against the law for you to go out and pull someone's credit report without their approval and consent. And that consent really needs to be written. It needs to be a written consent. So husband and wives, wives and husbands, partners and partners, you can't just go and pull someone's credit report, because that is against the law. So also when you do this, it's gonna have some security questions that only you really should be able to answer. So the questions could trick you up, but only stay true to what you know your answer is. So for example, the question could be, you've had a mortgage with A and B mortgage company, or X and Z mortgage company, or you did not have a mortgage. Well, if you've never had a mortgage, you know the answer is you didn't have a mortgage. Don't try to figure out what it is and you knew you didn't have one. Now, what could happen is something in the credit report triggers them to say your answers were not correct. So now you're going to need to mail in your requests. So you would then print the information and mail in for it. Those security questions are there to protect you and your identity, and not having just anyone pull your report. Because even a lender can't just pull your report unless you give consent for them to. So remember that it is against the law for anyone to pull your report without written consent. Also, be sure you're in a safe place when you do this, because sometimes library computers, they're public computers. So you may leave your information and forgot to log off, and if you leave it open, now some people can actually compromise your identity with your social security number and things of that nature. So be sure that you avoid public places when you do this, because you want to be able to look at your credit report in private and have access to it when needed. Next slide. So here I just give you some things about how long is information kept on your credit report. It is important to understand, because I ask this question, how long does things stay on the report? And I get all kinds of answers. So it's important to understand this, that open accounts in good standing, they stay on there indefinitely until they're closed, either by you or the creditor. Because if you're not using the creditor can close your account as well. So the key with credit is you want to be able to use it periodically. If you have a major credit card, use it for things like gas and pay it out when the bill comes. If you have a store credit card that you really want to keep, if you don't use it, they can close it. So buy something every now and then and pay it out. That is showing utilization, and that will then keep that credit open as long as the establishment is open, or so long as you're in good standing. Now, close accounts in good standing, they will close, but that trade line will stay there for a maximum of 10 years. Late or missed payments, remember that 30-day late payment I told you about? That is going to stay there for 7 years on the report. So anybody you're applying with, they're going to see those strikes of late payments. It doesn't necessarily affect the score anymore, but the history is still there. Now, collection accounts are important, because when an account goes into collections, you have in-house collections and then out-house collections. Out-house collections is called charge-offs. So once that account goes through a charge-off or a write-off procedure, because the creditor is getting it off their books by the law, that is there no activity, they have to get it off their record. So they may hire a collection agency, or they can sell it to a collection agency, or they can hire legal representation to collect on it. Once that charge-off or write-off happens and it goes into collections, that stays on your credit report for 7 years from the last activity date. So remember, all of these is per the last activity date. And a lot of times you don't know what the last activity date is. So keep that in mind. Civil judgments, meaning you've been sued, they will stay on your credit report for 7 years, depending on what the legal action is. It can go even further, but 7 years is what it normally will report when it's paid out. Chapter 7 bankruptcy, which is complete liquidation bankruptcy for individuals, it stays 10 years from the date of discharge. Discharge means you have completed the bankruptcy in court. So it will stay on your record for 10 years. If it's dismissed from the courts, that means it stays 7 years, but now creditors can proceed to collect on you as normal. Chapter 13 bankruptcy is what we call reconstruction bankruptcy, meaning that you're trying to get yourself together. So the trustees of the court will then actually decide how much of your debt you're going to repay through the court system. So Chapter 13 bankruptcy stays 7 years from the date of discharge, meaning you've completed it. The reason why Chapter 13 is only 7 years is because your repayment in the court system could take up to 5 years to repay. Then you have unpaid tax liens, meaning that you didn't pay your taxes. So now you have 10 years that's going to report, because you're open up for the government to seize your bank accounts or any funds that are out there that you may be getting, like tax returns, meaning that they had to forcefully take it from you. So always remember, any taxes that you owe, contact them and work on repayment. Don't just let it sit there, because they will file that tax lien on you. Also, paid tax liens. Paid tax liens, once you have resolved it and taken care of it, it will report 7 years from the date it was paid out. Credit inquiries, we talked about those earlier. They will stay on your report for 2 years. So that's how long information is kept on a credit report. Next slide. So how to improve your score is simple. Don't close unused credit cards. Just figure out if you want to keep it or you don't. If you don't want to keep it, then go ahead and close it. But if you have a number of cards that you want to close, don't close them all at one time. because just like I showed you in the percentage area of the pie chart about scoring, it will impact your score. When you close it, it's going to take a drop. But so long as you have other credit that's going to help pull it up, it'll start to climb. Don't open new credit cards to increase available credit. Once again, you want to open credit only when you know you need it, because having too much credit, once again, can be just as bad as bad credit. Next slide. Improving your credit score is another thing that you want to keep in mind. And how do you do that? Pay your bills on time. Can't stress that enough. If you pay on time, you won't have any negative credit reporting there. Also, get current and stay current. So if you are currently behind on debts, go ahead and get them current. You've made your mistake, but you can recover. And how do you recover? By getting current. And once you get current, stay current. Also, don't open a lot of new accounts rapidly. Like I stated, too much credit at one time that you're trying to open, it will cause the score to drop. Because remember, new credit is only 10% of your score, and new credit is definitely not 50% of length of credit history, because you're just opening it. Correct any mistakes that are on your report. Now, how do you do that? When you pull your credit report, it will give you information on how to dispute any incorrect information on the report. All the information that is entered is did by hand, and all the information on the credit reports are submitted to them by the creditor. So when it comes down to your trade lines, if you paid something out and it's still showing a balance, you have the right to dispute that. And you can dispute it with whichever credit agency has that reporting. So you would fill out the dispute form or the credit research form or whatever they're calling it, and you will submit it back to the credit reporting agency. The credit reporting agency will send it to the creditor. The creditor has 45 to 60 days to answer your dispute. One of three things will happen at that point. If the creditor answers back on time, and they realize that you are correct, the debt is paid, they will correct it on the credit report, and the credit reporting agency will send you a revised copy of the credit report. The second thing that could happen is if they receive your dispute or your research and they realize they're correct and you're wrong, they will send that back to the credit reporting agency. The credit reporting agency will then send you a notice letting you know it's a justifiable debt, and you would need to then contact the creditor, because credit reporting agencies only report what is submitted to them by the creditors. The third thing that could happen in this area is the creditor doesn't answer the dispute within the 45 to 60 days. So if they do not, at that point, the credit reporting agency will remove it from the credit report, but it's important for you to understand that it could come back. And the reason why it could come back is the creditor just has to re-report it. So you would have to go through the process once again. Also, if you're shopping for loans, be sure that you shop for loan rates within your focused time period. Now here we mean that there's a law in place that is called that you're doing credit research on certain things like a mortgage or for a vehicle. So once you are shopping for either one of those, there's a rule in place that if it's within a 14-day period, all the inquiries only hit your score as one hit, and weekends do count. So let's say you go in to buy a car and they're trying to get you the best financing. They may have your credit pulled from 6 different financing companies. If that is the case, you now have 6 inquiries that appear on your credit report. But if it's all done within that 14-day period, they may all appear, but they're only going to go against your score one time. So the key here is just be sure you don't have everyone pulling your report. Talk about what you're trying to get. Talk about what it may look like on paper before you give someone the okie dokie to pull your report. And that also goes for shopping for homes as well. You want the best lender, but talk it through first, because at least with vehicles, you can have your financing in place before you even go to the dealership. You want to keep balances low on your revolving. That is at 30% again. Stay below 30% of your credit score or lower. You also want to pay off debt. It's okay to pay out debt. It's okay that you're using it and paying it out. It's showing that you're utilizing the credit, but you're being responsible for paying it off. And you also want to check your credit report on a regular. So definitely take advantage of annual credit report, because that is important for you to be able to look at your report and look at it as regular as you can to make sure you're preventing identity theft or any type of fraud or any information being reported incorrectly. Next slide. So that concludes our credit management and credit scoring presentation. What you will see here is my contact information. As stated, my name is Phoebe Brown, and I'm the Financial Inclusion Officer with Hope Credit Union. My office is at the Elysian Fields branch, but we do have our OC Haley branch as well. I actually cover both locations, but during this pandemic, I am actually working remotely. So it would be better for you to email me at phoebe.brown@hopecu.org, because I will be able to answer you as quickly as possible through email. So I hope this presentation helped you, and I think if you have any questions, Alex wanted you to place them in the chat box. So I'll turn it back over to Alex Bigby, and we'll take any questions at this time.
Thank you very much for that fantastic presentation, Phoebe. Yeah, we do have a couple of questions. First question, is it okay to use student loans for a car, or is it better to take out a car loan?
It is better to take out a car loan. As I stated with student loans, they're just what they say. They're for your schooling. We've had people to do a whole bunch of different things with student loans, but the key is to remember you have to repay. So I would not advise that you take a student loan and use it to buy a car, because who's to say you can max out on student loans. So if you use the loan to buy a car, but then you realize your schooling needs to go further, but now you've maxed out your ability to get a loan, your schooling may then be stalled because you don't have the funds. That's why I always stress, only borrow what you need for school, because that is what that loan is actually for. If your credit is in good standing and you have income to show you can repay, you need to get an actual car loan to keep that separate. Don't intermingle that, because it can get sticky, it can get confusing, and you also can put yourself into an overextended situation on your student loans, depending on what your field of study is.
Thank you very much for that answer, Phoebe. This is a question from me. So most of the people on this call are small business owners, and probably curious about the differences between personal and business credit. Do a lot of the things you've talked about in this presentation also apply for business credit as well?
Business credit is a little different. A lot of the things do apply, but business credit is quite different. And it's sometimes very difficult for individuals to get business credit because they're not sure how that goes. There are business credit reports. So they don't appear on the regular TransUnion, Equifax, and Experian. You actually have to be sure that when you're opening business credit, you are opening business credit, because a lot of times people open credit for the business, but they're personally responsible and the credit is in the business name. When it needs to be the opposite way, the credit is in the business name, but you're backing the business, because they're going to pull your personal credit in order to approve you for business credit. So that's when you're done in Bradstreet report, your Experian business credit reports. That's where those types of credit would appear. So they are different. A lot of it does still remain the same, but business credit looks a little different because of the fact of what you're using it for. It might be to get a vehicle for the business. It might be to get a credit card to have a line of credit for the business. And you want it solely in the business in case something happens with the business and then you have to bankrupt the business. You don't want it to bankrupt you. You want the business to take the hit. You're the owner of the business. But a lot of times in this industry, I've seen people do it the opposite. They think they open business credit, but they really open credit under their name for the business. So when the business goes belly up, they go belly up as well because they're sitting holding all the debt for the business. So you have to be very careful in that area.
Great. Thank you very much. Are there any more questions? So somebody's actually put up a very helpful point on the chat box. Because of the pandemic, you can actually check your annualcreditreport.com score every week now, I believe, for free. So you don't have to worry about waiting a year. They've now let you check it every week because of the pandemic.
But I wouldn't really advise you to check it every week.
No, no, I wouldn't either.
because it's, first of all, it's not going to change weekly. Creditors only report to credit reporting agencies either monthly, bi-week, every other month, every 3 months, every 6 months, every year. So you really don't need to do that every week because it's not going to change much. The only thing that will change is your score, and you normally have to purchase that.
Absolutely. Any more questions? We're pretty close to our hour, but we have time for one more question, I think. All right. Well, I guess that is left to just thank you, Phoebe, for sharing your time and your experience. It's an excellent presentation as always, and great answers to those questions. Everybody, thank you for joining today's session, and yeah, looking forward to continuing to work on the Capital Ready program and working with everyone going forward. So everybody enjoy the rest of their week and take care.
Thank you so much, everyone.